We're now going to take a look at Chapter 3, Interest Rates and Security Valuations, on the concept of duration and how duration relates to interest rate risk. In particular, we're going to find that if we can find bonds whose duration matches our holding period, we can eliminate, or at least largely eliminate, interest rate risk. What do we mean by interest rate risk? By interest rate risk, we're simply referring to the fact that a bond's value changes in relationship to changes in interest rates. When interest rates rise, bond prices go down. When interest rates fall, bond prices rise. More specifically, that sensitivity of a bond's price to interest rates increases as the maturity of a bond increases. Long-term bonds have a much higher change in price in response to a change in interest rates than short-term bonds. And that makes sense. If interest rates change and we've got a 1-month T-bill, big deal. We can reinvest our proceeds from the sale of that T-bill at the new interest rate in a mere 60 days or 30 days. However, if we have a 20-year Treasury bond and interest rates change, we're stuck perhaps earning below market rates of interest for a long period of time, and that bond will suffer a big change in value. In terms of coupons, low coupon bonds are more sensitive to changes in interest rates than high coupon bonds, and that makes sense as well. High coupon bonds, we're really getting back more of our investment sooner, so we're subject to less interest rate risk. Low coupon bonds, and you could go to the extreme of a zero coupon bond, we don't get any of our cash back until maturity. When we typically think about interest rate risk, we think about that relationship between our bond price and interest rates. What often isn't considered is the relationship between interest rates and reinvested coupons. When interest rates rise, we can reinvest coupons at a higher interest rate and we'll have a larger future value. On the other hand, if interest rates fall, our reinvested coupons will grow much more slowly and we are worse off. Now here's the interesting and important part. Notice, bond values go down when interest rates rise, but the value of reinvested coupons increase. And of course, just the opposite is true as well. When interest rates are low, our reinvested coupons won't be worth as much, but our bond value will increase. We can make use of this natural trade-off through the concept of duration. Duration is a weighted average time to maturity of our bond or financial security. And if we find a bond whose duration equals our holding period, we'll find we can largely eliminate interest rate risk. Duration is basically measuring the sensitivity or elasticity of our bond price to small changes in interest rates. Let's go look at how we would calculate the duration of a bond. Again, it's simply a weighted average time to maturity. We've got a 20-year, $70 coupon bond with a 7% initial yield to maturity or required rate of return. So let's go ahead and find the present value of that bond. First, let's pick up the cash flows. That means the time one cash flow is $70. The times two cash flow is that same $70, and our cash flows $70 a year for 20 years, except in that final year, we also get our $1,000 face value or par value. Let's now calculate the present value of each of these. The $70 in year one is going to be discounted back at the 7% required rate of return, and it's going to compound for 1 year. Its present value is $65. The coupon we receive in year two has a present value of $61. The coupon we receive in year three has a present value of $57, and all the way down. And that last coupon in face value has a present value of $276, and our bond has a present value of $1,000. Not surprising, it's selling for par. Of course, if the coupon was lower, the bond would sell at a discount. If the coupon was higher, the bond would sell at a premium. But let's stick with our $70 coupon for now. We're going to view this bond, instead of being a single investment, let's view it as a series of investments. We've purchased a $70 one-year bond, a $70 2-year bond, a $70 3-year bond, and so on. And finally, of course, we've purchased a $1,070 and $70 20-year bond. Let's figure out how much of our investment is invested for each of these periods of time. So we'll take that present value of that first year coupon, divide it by the $1,000 price, and we can see that 6.5% of our money was tied up for 1 year. 6.1% of our money was tied up for 2 years. We've made an investment of 5.7% of our money in a 3-year bond, and so on. Most of our money was invested for the full 20 years. Now we're going to calculate a weighted average time to maturity. So 6% of our investment was invested for 1 year. 6.1% of our investment was invested for 2 years, and so on. I copy that all the way down, add them up, and I've got an average length of investment or duration of 11.34 years. What that means is that roughly half of our investment is tied up for less than 11 years, and the other half of our investment is tied up for more than 11 years. This 11.34 is the duration of this bond. Let's now go ahead and take a look at why duration is important and how we can use it to eliminate interest rate risk. So here's our bond. 20 years, $70 coupon, 7% yield to maturity. We calculated a duration of 11.32 years. If we have a holding period of 11.3 years, what this means is that if interest rates change, we'll find that we have very little, if any, change in the value of our future wealth. So right now, every time we get a coupon of $70, we reinvest it at 7% interest, and it's going to grow over that 11-year period to $1,151. At the end of the 11 years, if interest rates remain at 7%, the bond will sell for par value, or $1,000. Now, the question is, what happens if interest rates rise? Well, if interest rates rise, we would expect the value of reinvested coupons to go up, and we know the value of our bond will decrease. So let's bump interest rates up by 1%. If interest rates go up by 1%, sure enough, the value of our reinvested coupons goes up from $1,151 to $1,216, and the value of our bond goes down. Notice, overall, did we have much change in wealth? And the answer is no. What if interest rates went down to 6%? The reinvested coupons are worth less, but that's made up for by what? A higher bond selling price. So as long as we have small changes in interest rates and we find a bond whose duration matches our holding period, we can insulate ourselves from interest rate risk. If we have a 15-year holding period and we buy a bond with a 11-year duration, we have interest rate risk. And our risk is if interest rates go down, because our money's tied up for 15 years. Those reinvested coupons aren't going to be earning our 7%. They're only going to be earning 6.5%. And it's going to be significantly less than we thought it would be worth. And that's not offset by the higher bond value because the bond only has 5 years left until maturity. On the other hand, if interest rates go up, we are better off because we will have benefited from those higher rates of returns on reinvested coupons over that long period of time, and we have very little time to have an impact due to higher interest rates on our bond price. On the other hand, if we find a bond whose duration is 11 years and we only have a 5-year holding period, we certainly don't benefit very much from higher interest rates. Sure, instead of having $402, we have $406. Reinvested coupons are worth a little bit more, but certainly not enough to offset the large decline in the price or value of our bond when we go to sell it in 5 years. And of course, the opposite were true if interest rates had dropped. So if we have a bond whose duration doesn't match our holding period, we are subject to interest rate risk. If we can find bonds if we have a holding period of 11 years and can find a bond with roughly an 11-year holding period, we are basically insulated from our interest rate risk. And if we can match it exactly, we have no interest rate risk at all because we're benefiting from that natural trade-off from the value of the bond versus the value of reinvested coupons. Let's say we had a 9-year holding period. This isn't a great bond for us because its duration is 11.32%. What if we found a bond with a slightly higher coupon? Because remember, the higher the coupon, the more of our cash we're getting back sooner, which means it has a shorter duration. If this bond had a $100 coupon, it's still not quite there, but as the coupon rate goes up further and further, we're getting back more of our investment earlier, and that duration is dropping and it's getting closer to that holding period. Ideally, we would look for a bond with a shorter term to maturity. On the other hand, if we had a 14-year holding period or investment horizon, we would want to find bonds with lower levels of coupons. A $50 coupon gives us a 12-year duration. If we found a 20-year bond with a $30 coupon, it's getting close. A $20 coupon, a little bit much. What if we found a bond with a $25 coupon, very close to our 14-year holding period? And you can see we are insulated from interest rate risks in terms of our total future wealth.